Welcome to Technically Fundamental Podcast. I'm here with Michael, Lindan. Hello, Michael.
Hello, Jacob.
We took a little break since our last episode. So far we've covered 3 companies, 2 together with Michael and 1 I've done on my own. And all of them we've watched for last 6 months. And now we're back to talk about not how good the companies we talked about first, but about the UK stock market as a whole. But if you care to look at them, you'll see that On The Market PLC has been bought up, and Meta did quite well as well.
Yeah, Meta's added about 40% since we talked about it.
And InPost is over 12 euros at this moment. I think it's 12.60 or 12.50, something like that. So all 3 stocks we covered did quite well, and now we're back because we have a bit of time to talk about the UK market. So I know Michael has a lot to say about UK market from the fundamental and fundamental opportunities. So because he's very much an expert in UK stock market. Unlike me, I deal more with Polish market and charts. Before we go deeper to stocks and indexes in the UK, I want to just share with you guys that what I shown Michael before. I shown him some of charts that I've done last night. So I've looked at long-term trends and channels on S&P 500, on Hang Seng, Nikkei, and on Polish stock exchange as well. To cut the story short, they all point out that it's a good opportunity to get out of the US market and get into emerging markets and developed countries like UK, Poland, Spain, Germany, Japan, and definitely China. China is the way to go. We're at a very good, probably lifetime opportunity to move over there. And I know some people who do a lot of ETF investing, and they are swapping the American positions for Chinese and emerging markets right now as we speak. That's it as an introduction. Let's keep it short and tidy. Now, Michael, welcome to the podcast again. Let's start on the UK.
Yeah, thanks, Jacob. It's a pleasure to be here with you in your studios again. I'll just pick up on what you said about it's good to perhaps get out of the US, and having shown the chart that the US market is at a record high. Interestingly, I was just looking at some data over the 50 years from 1900 to 1950 on the Dow, as it was then. And in those 50 years, effectively, you had 10 bear markets, 10 big bear markets, where basically the index was halving, it was cut in half. And those bear markets in 50 years were happening every 4 to 6 years. So every 4 to 6 years in America, they had a very big bear market. And then they had the longest bull market that they had at that time lasted 11 years. In those 53 years, 1897 to 1950 is the period we're discussing. Now, if you just fast forward to today, we've just had, we're still in it, a bull market from 2008, after the financial crisis, till the present day, which is 2024 almost. So you're talking 16 years of uninterrupted bull market.
Yeah, it's probably one of the longest.
Yeah, it actually is the longest in history.
Yeah.
And so you've got to ask yourself, are the bear markets basically finished? Is that the end of the bear markets, as we've seen them historically the last 150 years? And you laugh in there, and so am I. And I think any sort of person that has read a bit of history will say, well, actually, it's unlikely.
Yeah.
Right? The markets do go down with regularity. So, and so that data really supports, your interpretation that at some point the US is going to go, the US market will have a bear market.
Yes. I'm unable to time it well. You can't say, this is going to be this year or next year.
We just don't know when exactly, but what we do know is the longer this bull market goes on, the closer to the bear market we are.
Yeah, that's pretty much the best assumption we can get.
And that's about as rational as assumption as we can make. So if we don't like the America, the American companies market, and I will refer to the stock market as the companies market because, for some of our listeners out there who perhaps don't associate the two, who thinks that the stocks are things that bob up and down on the screen.
Yeah, so some kind of pieces of paper.
Some kind of electronic tags. So what stocks really are is basically small pieces of companies. And therefore it's legitimate to call the stock market the companies market.
Yeah.
Because effectively that's what it is. So I suppose that the genesis of today's discussion and the main thesis is the following, which is if you can't be in America because the bear market is likely upon us, then why not England? And looking at England, we see an opposite story, basically, that the UK's stock market hasn't really done much for 20 years.
That is true. I looked at the charts last night, and it looks that it was moving sideways for last 20 years. No magnificent gains, nothing there. And well, it didn't fall much. It didn't go up much, but right now we're at a very, very good opportunity to buy, I think, chart-wise, definitely. But also, if you look at the valuations of some of the companies, they're becoming ridiculously cheap.
Yeah, and we'll look at that as we progress. The other thing is that, of course, so we both agree that the UK has gone nowhere in terms of its company market in 20 years, and the chart supports that. And if you think about the valuation, the FTSE 250, for example, is on 11 times earnings.
That's very cheap, yeah.
Okay, and historically, 11 times is basically cheap in all interest rates environments. Ben Graham in his 1930s book Security Analysis basically writes that, look, in all environments, 12 and a half times, 12, 13 times for a company of earnings is not expensive.
Yeah.
Okay, and we're at 11.
Yeah.
Okay.
Oh, we can find companies with even lower.
Yeah, and we can look at companies with even lower P's. But also what I would introduce into the discussion is the fact that when Ben Graham wrote this in 1930s, the average company in the index was a lot lower quality than the average company in the index today.
Yeah, well, of course, they're much more agile, they're much more flexible, they went through COVID, they went through Brexit, they're much more resilient right now. And I would say what we will talk about, this is not only us that noticed that the UK companies are cheap as hell. Not only us noticed that. And the amount of takeovers, we're talking Marks and Spencer, we're talking Ted Baker, with On the Market PLC,
the one we
Hotel Chocolat. We had a brief history of Hotel Chocolat, and we made a lot of money because we bought it cheap, and then Mars decided it's still cheap yet, and we just, it was a so these things are happening right now as we speak. Some American big massive companies are looking at the British stock market, well, let's call it companies market, and like, oh my God, these companies are dead cheap. Let's get them.
Yeah, you make a very good point. What we've witnessed every day, you open the newspaper and you see yet again another American private equity fund or pension fund buying out UK companies.
Yeah,
whether it's On the Market PLC, you mentioned Hotel Chocolat, Morrison's was the large.
Sorry, not Marks and Spencer.
Yeah,
it was
Morrison's was the large supermarket that was taken over by the Americans, and it's not even the Americans now; it's the Saudis as well.
Saudis
buying the Heathrow Airport. There's the Chinese buying the Manchester Airport, and so there's a lot of outside interest now. It is basically picking up, right, in the UK. Now that interest was dead for quite a while when Brexit happened.
Yes.
And that basically made the UK look like a basket case to a lot of international institutions.
It pushed valuations down as well.
Yeah. And that's what happened with the Brexit. It did push valuations down. It did push the pound down.
Oh yeah.
Okay. And then of course we had the debacle with Mrs. Liz Truss and her Chancellor that also scared the markets.
Yeah.
And so the UK economy for a while was actually the worst performing out of the G8. So yeah, we've had quite a few prime ministers. So all of that has knocked confidence.
Yes.
To a point where basically, as we said, the UK companies market hasn't gone anywhere in the last 10 years and in the last 20 years.
Yeah.
Because it's just been looked at as a little bit of a sick man of Europe. The case that we making, and I certainly am making, is that actually it ain't necessarily what it looks.
Yes.
And there is hope for the UK companies market, and we actually think that in 10, 20 years from now, it will produce outsized returns, better returns than average. Whether it's on index basis, be that FTSE 100, FTSE 250, FTSE 350, FTSE all shares. So there's some variety of the indexes that one can pick to individual names, and some of the names we can look at. So this, I suppose, you could sort of say that this podcast is basically making the case for the UK, and to some of the people out there who perhaps don't understand what the company's market is or what's it for. We're putting it simply and saying, look, the company's market in the UK, of the UK listed companies, right, at present is basically good value, on an index basis or on individual company basis. To my mind, looking at it, if you go up and down that FTSE All Share index list, which has got about 625 companies, you've got FTSE 100, the 100 large ones, and then you've got the smaller ones. Pretty much most of them, with the exception of a few overvalued ones like AstraZeneca, are basically good value. So if you are a retail and amateur investor, and there's something out there in the UK that you like, maybe you work for the company, or maybe you understand what it does, what products it sells, and why, or understand the industry, then probably now is as good of a time to pick that company than ever.
Yes, well, you can also make a reasonable argument for buying ETFs. Obviously, we are more of a stock pickers. We embrace the art of investing and picking stocks and analyzing all the indicators and revenues and earnings and all that. But then again, if you have long-term attitude and want minimum effort, you far more better, just all other things equal, you far more better picking British ETFs at the moment, British stock market ETFs over American ETFs. Yes. Because I'm fairly certain they will do better over next decade than Americans. American stock market may crash. It may go flat for next decade. Obviously we don't know the future.
Yeah.
If we look at the valuations, if we look at how cheap the companies are, there are plenty of cheap companies in the US, don't get me wrong, there are. Apart from Magnificent Seven that drew most of the growth in last year, and not much of other stocks moved in any direction. Like Pfizer went down 50%. So there are opportunities in the US market, but on the US market, you have to be very, very skillful and careful stock picker to pick the right stocks. Whereas in the UK, everything is freaking cheap.
Exactly.
So if you buy an index, if you buy ETF, you will do well, even if you don't know, nothing about investing.
On an index basis, I mean, I obviously concur and agree with you, Jacob, there. On an index basis, we mentioned the FTSE 250 index, which is on about 11.
That's my favorite index here.
Yeah, it is my favorite index here, actually, in the UK, the FTSE 250 as well. Now, if you compare that to S&P 500, that's on a price to earnings of about 18, 19. Okay, so there is your difference right there, 11 and 18, and that really is sort of the difference between, we can get into some major companies there, but that in the same industry, but the ones listed in London versus the ones listed in New York.
Yeah.
If we look at, say, something like British American Tobacco or Imperial Brands, the two tobacco companies that are listed in England, well, they are on a, price to earnings ratios of sort of 7, 8, 9.
Yeah.
But if we look at, say, it's like a Philip Morris, which is listed in America, then that's on a multiple of 18.
Yeah.
And so we looked at that tobacco industry, but if you look at across the industries, whether it's retail or whether it's beverages, soft beverages or alcoholic beverage, that's or the financial industry, that's the kind of difference you're getting.
Yeah, the British ones are definitely in the lower multiples.
Yeah,
much lower.
And then you've got to ask yourself, well, overall, are the British companies that much? Are they worse? Should they be on a lower multiple? Is a Diageo, for example, so much worse company than PepsiCo that it should trade with such a discount? Is British American Tobacco, so much worse company than Philip Morris that it should trade at half the valuation?
Is Hargreaves Lansdown so much worse than Interactive Brokers?
Or Charles Schwab?
Yeah.
And the answer is we don't think so.
Yeah.
The UK has got good property rights, good democratic institutions, the English language, and good history, actually, of property rights and of capitalism. That actually it doesn't seem to me all that sensible that it should trade at almost half the valuation.
Yeah, well,
of the USA.
It's also a case of to make about the market as a whole. It tends to go from overvalued to undervalued, and right now the US stocks, some of them, many of them are overvalued, whereas when you look at the British stock market, some of the companies are massively undervalued, and it's not only that risk to reward ratio is better in the UK, because it's probably more likely that the multiples will increase in the UK, so you actually make the valuations will grow, whereas it's more probable they will fall down in the US. That's not only the one factor. There's also a factor of we have these periods of domination. So there are periods of US stock market dominating other developed and emerging markets by creating more returns, better returns, and there are periods where other markets create better returns and better opportunities outside of the US. And we have been dominated by the US for over the last decade, 13 years, right? So my point is, because obviously we will talk about the UK today, but you know damn well that I look at the Polish stock markets where the valuations are even lower than in the UK, because we have companies back in Poland at a PE of 3, a PE of 5, companies that make record revenues and they're healthy with great balance sheet, with return on equity for last 10 years 30% or 20%, year in, year out, and then the valuations of PE 8. It's just ridiculous. You look at China, it moved nowhere for the last 20 years, right? You look at India, you look at Israel, you look at, but obviously we live in the UK, so it's the best option to invest is when you have your own money.
Yeah,
so
we understand.
But my point is, we're not the only ones seeing this.
No.
There are people with massive wallets, right?
Yes,
they are very wealthy.
Yeah.
There are very wealthy equity investors.
Yeah.
There are very wealthy private equity funds and other funds that are noticing those opportunities in emerging markets and in developed world, and they will. And and my point is, because I don't know how it looks in the UK, maybe you know, but I know that 40% of all the volume traded in Polish stock market is US funds.
Yes.
So 40% of money, and that tells me something. Americans are buying there too. They are pouring in money because it's that cheap and successful. UK is not a failed state.
No.
UK is a successful, developed country.
It's a big modern nation.
Big modern nation. Yeah. I know you like that phrase.
Yes, I do,
you use it to you use it about China a lot as well.
Yeah.
Right. So it's a big modern nation.
It is a big modern
nation. With all the benefits of being a liberal democracy.
Absolutely.
With respect to private ownership, to all that, to respect to the law. And it's just it just makes sense to swap overpriced stuff for underpriced
Yeah,
stuff.
and also if you think deeper than that, if you think a bit further, well, America has basically started in England. Okay. Now some people would debate it, but
Yeah, that's true.
but in
Okay.
1600s, it was the Glorious Revolution, okay, in England, okay,
Yeah.
which has really brought us those institutions that we have today, and then it was the Industrial Revolution in England, okay.
Guess where? In England.
Yeah, that has basically brought us, okay, the system, the capitalism system that today, a country like the USA, okay, enjoys.
Well, yeah, railways and steamwork and
that's
everything.
where it happened.
That's where it happened.
So it has a rich history. The UK has a very rich history of democratic institutions, of capitalism, of property rights, which over the centuries performed well, okay, with this or the other leaderships, be that conservatives or Labour or liberals, etc. And that's effectively, I think, is what we're saying is look, this is a big modern nation, a developed nation, which has a lot of companies on the market, a lot of consumers. It's population like next to 70 million people.
Yes.
Not far off
Not
now.
far off.
That basically, if you look at it in the context of the globe, is a very good place to be investing in. And when you get that coupled with a historically cheap price, which is 10, 11 times. Now, historically, 10 times earnings has been always considered a cheap price, historically.
Yeah,
okay?
yeah.
Over,
That's
again, over a 150-year period. It's only now that, we got, it's only in the last 20 years, and mainly in America, where we got accustomed to something trading on 30 times earnings, or 32, 33, 35 times earnings.
or more.
Or more even, that's right, in the case of some of those tech companies, as kind of, palatable, as kind of okay. But actually, this is a very recent phenomenon. It really wasn't okay,
I think it will level down. I think it will go back to normal at some point. But it's not only an opinion, right? Because you can have an opinion on the UK, but there's a proof.
Yes.
Like when you think the direction that people migrate to.
Yes.
They don't migrate to Russia.
No.
They don't migrate to Egypt or something. They tend to migrate to the Western European countries, which are highly developed and have all this safety net for people.
Yes.
And they've got all these advancements of capitalism and property rights and so on and so on. So not only people vote UK with their footsteps.
Yeah, as Milton Friedman has said.
I've actually watched his show back in the past. But anyway, they also vote with their wallets.
Yes.
And that's why all the Saudi Arabian money pours over into the UK. You've got Chinese money pouring over here. Chinese investors buying blocks of houses in the UK. You've got Russian oligarchs buying here. You've got all the money in the world is pouring into the UK. Mostly in recent, I'd say, decade, because of the real estate. But the real estate is quite expensive right now. It's the most expensive in the UK since Victorian times. So at some point, this money, this excess of money that is pouring into the UK will shift to buying not only real estate but also companies.
Yeah.
So we've seen it from US, but I think we will see more of it. I think we will see more of the money landing in the stock market in next decade.
And I agree, and I also think that as the UK companies market will become larger itself, it'll become more noticeable itself, because one of the points to make, I think, which is important, is that the UK market in comparison to, say, the US is still very small. We talk about the FTSE 250 index, okay, and that sounds like a whale, but FTSE 250 index, when you take all those 250 components, is only 300 billion
So that's less than Apple.
Is that, well, 300 billion is only 1/10 of an apple.
Yeah.
Okay.
Which is 3 trillion right now.
Yeah. So just think of this. We're talking about the UK index here with 250 companies, and that's only just over 1/10 of one American company. Or take another company, Coca-Cola, which was 250 billion. So here we have the whole UK index, which is pretty much the size of one US company, Coca-Cola, right? So then you say, so then you kind of look at it from a different angle and you go, okay, so the UK market is actually very small. Well, yes, it is, in comparison to some of those magnificent 7 tech companies in America that are worth trillions. And so usually, if you are smaller as a business or as a stock, those smaller stocks, well, they tend to, it's like trees, they tend to grow, or people, they tend to grow faster when they're smaller.
Yeah.
Yeah?
Because there's a small base.
Yeah, the small base. It's like a 5-year-old child is going to grow faster than a 15-year-old child or a 25-year-old. So actually, you look at some of the bigger companies in the UK, like the British American Tobaccos or the Diageos or the Unilevers of this world. But these companies are really only 40, 50, 60 billion market cap. Right? Now, for the UK, those are huge market caps. Market cap meaning the company's price. But actually, if you compare them to something like an Apple, or a Coca-Cola or a Facebook, they're only 1/10 or 1/20 or 1/30, okay, of some of those US-based companies. Did you see what I'm suggesting there? So what I'm saying is, look, you can jump into a FTSE 100 company, right, and say, hey, this is the large company in UK. Yeah, it maybe is large for the UK, but British American Tobacco with its 50 billion market cap, sounds very large, and it is the largest nicotine products company in the world, right? But actually, it's a small company in comparison to some of its American peers. And then we look at, we can look at luxury goods, for example. You take a Burberry, which we can, get into.
Oh, I like Burberry.
Yeah, I mean, Burberry is a luxury brand. It's probably the only company in the luxury sector which is mono brand. Okay, it's got that one brand, Burberry, and the market cap is just over 5 billion. Okay, 5 billion pounds. Now compare that to something like an LVMH, a conglomerate, which is over 400 billion pounds. Okay, so it's almost 1 to 100. But then you can say, okay.
Yeah, but LVMH has many brands.
Yeah,
right?
LVMH has 75 companies in it, for sure.
75 brands, right?
Yeah, so maybe more.
So if you divide that by 75.
Yeah, so if you divide that by 75, then you pretty much
similar, isn't it?
You get to similar. But then again, let's look at the point we're making on the valuation. Burberry is at 12 to 13 times. LVMH is on 23 times, 24 times. So LVMH is actually twice as dear, and yet Burberry has got 48% of its sales in Asia.
I love Burberry. We've talked about it just a bit recently, and I went to the shop. The stuff they make is amazing. It's so good quality. It's so well designed, and there were at least 7 people in that shop. So there are people. Well, obviously it's Christmas, but there are people browsing these 400 pound, scarves. You got a scarf.
Well, it's a 150-year-old brand.
It's a very respectful brand with
only
very
British
traditional
luxury brand.
Very traditional design. I like the patterns they use. Those patterns. You look at the patterns of Burberry clothing, and you're like, this is British. This is Burberry.
Yeah.
This is.
No, it has an appeal. It's a 150-year-old brand. The only really luxury brand that the UK has, actually, and interestingly, it hasn't got any family ownership or family control. So it's very much a candidate for a takeover by someone like LVMH or Hermes or perhaps some of the bigger American houses. Trading at 12, 13 times earnings. It's a good example of a UK company trading at a discount to its global peers.
Yeah.
You look at the Hermes, which is 10 times its sales, or look at LVMH, 24, 25 times its earnings, and Montclair or something like that. They're all double the valuation, and I think what's happening is basically at the moment is if a company is British, it's been heavily discounted, and we just don't think that that's reasonable. You have these discounts even within the same brand. For example, let's talk about Domino's Pizza. Domino's Pizza, again in the US, is on sort of over 20 times earnings.
Yeah.
And then you've got Domino's Pizza in the UK, it's sort of again 12, 13 times. And then you look at it and you just think, well,
and it was cheaper as well.
It's the same pizza,
Yeah.
It's the same pizza, it's the same brand.
It's the same business model.
It's the same business model. That's right. What is exactly
all things being equal?
All things being equal, you're actually getting a lot more in Britain than you are in America.
Yeah, and it isn't going anywhere as well. It definitely won't stay that long. It won't stay that low for a long time because again, private equity funds and all sorts of institutional investors, they are noticing it, and we have proofs of that.
Yeah, they are noticing it, and you only have to, as I said earlier, you only have to open a business section of a newspaper, and every day you see
something is being taken over.
Something is being bought in Britain by someone outside of Britain on the company's market. Now, whether it would stay like that for long or not, nobody knows. But if inflation is coming down, as they are talking about in the news, from this morning, and then who knows? Maybe we've got an interest rate cut on the cards. Maybe we don't. Who knows? No one knows. But historically, 10 to 12 times has always been cheap over the 150 years. And that's basically that. If it's cheap, it's.
Yeah, as an investor, I wouldn't bother myself about predicting what will be the inflation next year or next month or next 2 years. I don't really care that much.
Nobody knows.
The most important part is you look at the company. If it's valued cheap, it's valued cheap. Just figure out the reason and whether there's something wrong or not with the company. And the companies like Burberry, the return on equity is stellar. It's outstanding. It's like Hargreaves Lansdown. The return on equity and return on capital employed in Hargreaves Lansdown, it's outstanding.
So just for our listeners there, one of the ways to measure the quality of the company is to look at some ratios of its returns, like the return on equity and return on capital that the company is producing. And the point I was making in the beginning of this podcast is the following. So over the 150-year period, 10 to 12 times earnings, has always been considered a cheap stock. And, Ben Graham writes about it in his security analysis in the 1930s, right? But the point I'm making is that in the 1930s, the average return on equity or return on capital of the company, right, in the stock market was a lot lower than it is now, because now you have completely different business models. If you think about in the past, mainly companies were very capital intensive. It was about buildings, it was about railways,
yes.
It was about the oil and mining companies,
machinery,
and those were the main assets that were on the company's balance sheet.
Yeah.
But if you look now, mainly on the better companies' balance sheets, you've got things like brand value, things like intangibles, and plus you've got this appearance of technology where a company like a Hargreaves Lansdown is a good example, has one building and has 1.8, almost 2 million clients from one building.
Well, yeah, this magical thing called internet.
Yeah, this magical thing called internet, technology and intangibles. Now, you didn't have that 100 years ago. You couldn't have, or 50 years
Oh,
ago.
it's impossible to serve 2 million customers from one freaking building.
How?
You'd have to have actual,
Yeah,
shops open in every major city.
You couldn't have, you couldn't have 2 million customers from one building.
Look at ASOS.
Yeah, look at ASOS. Exactly. It's basically
billions of revenue. Billions.
Well, mainly it's an online retailer.
Well, they've recently opened a shop, pop-up shop in London, but before that they haven't had a single shop, have they?
So if you then take the historical premise that 10 to 12 times is cheap, which is where we're at, but if you then add to that actually the average company in the index now is a lot better company than it was, because we've mentioned Hargreaves Lansdown that's got over 50% return on capital, and Burberry over 20% returns, and some of the others, Diageo, Unilever, British American Tobaccos, all these companies have got 20 plus returns, 20 plus percent returns. So they're better companies than the ones you ever saw, 100 years ago.
And they still value that PE of...
and they're still valued at the valuation of the companies 100 years ago.
Yeah.
Okay. And by the way, the interest rates historically were also
much
higher. Okay, than they are. Even at the moment. So when you take a sort of historical perspective on this, then you come to the conclusion that actually the UK market is basically very, very well. It's cheap. It's basically cheap. It's cheaper than the average historical market has been.
Yes.
So that's really the conclusion. The thought here, which is backed up by some of the numbers that we have provided, that the UK market is cheap historically. It's cheap on an index basis. It's cheap on an individual issues, on an individual company basis. And it's cheap on relative basis in comparison to the United States. And then we can develop that thought and say, well, is this just a UK phenomenon? And you've mentioned Poland,
China,
and China, and I tend to agree with you. Is in that the European continent, the Eastern and Western, or Western and Eastern Europe, is actually an interesting place to be in right now. Again, whether it's on index basis, index being an aggregate of all companies in the marketplace, or on individual company basis. You just look at the dividend yields of some of those companies. M&G, for example. M&G is a large insurance provider, and that's on a dividend yield of almost 10%.
British American Tobacco has 10%.
10%. The Legal in General has got 8 plus 9% dividend.
Yeah.
So the dividend yields in the UK on average are actually much higher.
About 4 times higher.
They are, certainly twice higher than the American counterparts. Burberry's got over 4% dividend yield.
No, that's twice as high. But 10% is like 10. You buy British American Tobacco, you get 10% dividend.
Yeah, Imperial.
Mostly in US is 2.5%.
Yeah, 9%.
That's kind of average.
Yeah, and Burberry's at 4% dividend yield in comparison to, say, LV, that's 1.5%.
Yeah.
You look at Hargreaves Lansdown, is at 6% dividend yield in comparison to, say, Charles Schwab, just under 3%.
Yeah.
So the dividend yield is also a kind of another important yardstick to some of those income investors out there.
And that's good as well.
Yeah, and that's absolutely fine. When you've got a higher dividend yield, and basically the UK has got very high dividend yields in comparison to America across all industries, whether it's the luxury goods, whether it's the insurance or the banks or the food companies or the cigarette companies, the dividend yield is basically double the American counterparts, and that basically tells you where we're at as far as the valuations is concerned.
From what we said right now, it looks like, just to wrap things up, I think, it looks like, if you look at the charts, UK is better than the US.
Yes.
If you look at valuations multiples, UK is better than the US.
Yeah.
If you look at dividend yields, the UK is better than the US. So it doesn't matter whether you're an ETF investor, stock picker, dividend investor, value investor, growth investor, it's all there.
Yeah.
The UK is far better opportunity right now than the US. And I think that was the whole point of this episode, right?
Yeah, and the point, absolutely, obviously that was indeed the point, and it's really to just alert some of the people out there that perhaps are, not looking for the company's market as a medium for investment, and perhaps they've got pensions and the pension advisor is promising them this or that, and it's basically to say to those people is, look, this is all very simple. If you believe in the UK, your home country, okay, and you think that over time, 15, 20, 30-year period, the UK is going to develop and flourish, right, then effectively you don't need no pension advisor and no advisor to take part in that, because you can go away and buy yourself a piece of ETF or an index, a UK-based index like FTSE 250, FTSE 100, FTSE 350, FTSE All Share, and basically say, hey, I'm betting on England. So effectively what we've done in this podcast, we've given people an opportunity to bet on England, on the United Kingdom.
Yeah, just to remind everybody, this is not our episode, our podcast shouldn't be considered as financial advice. No. It's just our opinions are just ours. You have to make your own mind. You have to make your mind. I can't do it.
You have to make your own.
I'm gonna have to cut this.
Absolutely. It's a disclaimer. If you go away and do what we recommend, it's your problem. Yeah, it's fine. We can probably leave it as is, actually. It's fine.
Make up your own mind. Make your own decisions. This is your hard-earned money.
Yeah,
you've got to think for yourself. Don't listen to anybody. We are just here to help you find those measurements that will tell you something about different markets. It's a simple question. Do you expect the valuation of 28 or 60 PE go much higher, or do you think 12 will rather go higher and 60 will more likely go back down to some kind of average of 20 or something? What's more probable? That's what you're supposed to think.
And I'm like your pension advisor. We're not selling you anything, and we
don't get any money from that, right?
We're just a couple of observers.
We don't have any interest in whatever you do, right?
So here we are.
Thank you for listening, and speak
to you again.
Yeah. Bye.
Bye.